Before we begin, make sure you subscribe to Capital Explained because what you're about to hear is not just information, it's a warning. Something happened in the bond market last week that most people are completely ignoring. Not because it's complicated, but because it's uncomfortable. Because once you truly understand it, you can't unsee it. The system looks stable on the surface, the headlines are calm, the experts sound confident, but underneath, something is breaking. And history tells us when the bond market starts sending signals like this, it's never random, it's never harmless. It's the beginning of something much bigger. So stay with me till the end because this video could completely change how you see money, risk, and your future. Something unfolded in the bond market last week that most of Wall Street would rather you never fully grasp. Not because it's too complex, but because it's deeply unsettling. Once you understand what it really means, you start to see that the entire financial system people rely on is sending a warning. Loud, clear, and backed by history. And at this point, ignoring it is no longer an option. Let's look at what just happened. The yield on the 10-year US Treasury jumped from 3.97% in late February 2026 to 4.44% by the end of March. That's a sharp 47 basis point increase in just about a month. At the same time, the 30-year yield is climbing toward 4.9%, dangerously close to the psychologically critical 5% level. In the world of bonds, there's a term for the forces behind this move, bond vigilantes. And for the first time in more than a decade, they are back in action. Recent Treasury auctions across 2-year, 5-year, and 7-year notes showed weak demand across the board. Primary dealers, the institutions required to step in when others don't, ended up absorbing nearly 25% of one auction. That's roughly double their usual share. Think about that for a moment. The buyers of last resort had to step in, and now the market is demanding higher returns just to lend money to the US government. This isn't random noise, it's not a temporary glitch, it's a signal, and that signal is a code red. By the end of this video, you'll understand exactly what that signal means, why it follows a pattern that has already wrecked economies in the past, and most importantly, what you should be doing right now before things escalate further. Stay with me, this matters. Before we go deeper, you need to understand the mechanism behind all of this, because every historical example, every data point, every chilling similarity only makes sense once you see the pattern. Every major bond crisis in history has followed a 4-stage cycle. No exceptions, no deviations. This isn't theory, it's a repeated chain of cause and effect. Stage 1. The illusion of stability. Money is cheap. Credit flows easily. Deficits don't seem dangerous. Investors believe the good times will last forever. Risk is ignored. Leverage quietly builds in the background. Everything feels under control. Stage 2. Overextension. Debt starts reaching unsustainable levels. Deficits expand rapidly. Interest payments begin consuming a larger share of the budget. Foreign investors grow cautious, but markets still appear stable. Yields haven't exploded yet, so everything looks fine on the surface. That's what makes this stage so dangerous. Stage 3. The trigger. Something breaks the illusion. It could be a policy mistake, a surge in inflation, a geopolitical shock, or even a failed bond auction. Confidence cracks. Investors stop buying and start selling. Yields spike. Borrowing costs surge across the system. Governments get trapped. They can't let rates rise, but printing money risks destroying their currency. Stage 4. Forced resolution. The crisis ends, but not cleanly. It resolves through default, inflation, currency collapse, financial repression, or a combination of all of them. Those who understood the pattern survive. Those who ignored it pay the price. Now let's see how this has played out before. First example, 1994, United States. The economy was booming. Growth was strong. Inflation seemed under control. The stock market was hitting new highs. Bond yields were low and confidence was everywhere. Classic stage 1. Then the Federal Reserve made a small move, raising rates from 3% to 3.25%. It didn't seem like much, but markets were heavily leveraged and positioned for low rates. That small move triggered a chain reaction. The Fed kept hiking again and again. By the end of the year, rates had jumped to 5.5%. Long-term yields surged. Bond prices collapsed. In just 1 year, investors lost over $1 trillion. It became known as the Great Bond Massacre. And the key takeaway? Almost nobody saw it coming. Second example, 2022. After the pandemic, interest rates had been near zero for years. The Fed's balance sheet had ballooned massively. Money was easy, spending was huge. Again, stage 1 moving into stage 2. Then, inflation hit hard, reaching over 9%, the highest in decades. The Fed had no choice. Rates were raised aggressively, from near zero to above 5% in about a year. The result? The global bond market suffered its biggest loss ever. The Bloomberg Global Aggregate Bond Index dropped 11%, translating to over $2.5 trillion in losses. Once again, most investors were caught off guard. They believed the system had changed. It hadn't. Third example, 1998, Russia. The government had accumulated massive debt and was relying on short-term borrowing. Foreign investors flooded in, chasing high returns. Everything looked stable on the surface, but the system was fragile. Then, oil prices collapsed, revenue disappeared, debt couldn't be refinanced. Russia defaulted and devalued its currency. Global markets panicked. A massive hedge fund, long-term capital management, nearly collapsed under the pressure, threatening the entire financial system. A bailout was required to prevent disaster, all triggered by a bond market crisis that was ignored until it was too late. Now bring it back to today. Let's apply the same pattern to the United States. For years after the 2008 financial crisis, America lived in stage 1. Interest rates were near zero. Borrowing was cheap. Debt kept rising, but servicing it remained manageable. In 2020, rates effectively dropped to zero again. Spending exploded. Borrowing surged, and investors kept buying, confident that the system would always be supported. But stage 1 never lasts forever. Now we are deep into stage 2. The numbers are staggering. US national debt has crossed $39 trillion. The projected deficit for 2026 is around $1.9 trillion, nearly double the long-term average as a percentage of GDP. Even more alarming, interest payments alone are expected to reach $1 trillion per year, now exceeding the entire defense budget. Think about that. More money is being spent on interest than on national security. Debt to GDP is already above 100%, and projections suggest it could reach 120% within a decade. But here's the real problem. In the past, high debt was manageable because the economy was growing rapidly. Today, growth is slowing and the population is aging, and there's one critical tipping point approaching: when the interest rate exceeds the economic growth rate. Economists call this RG. When that happens, debt begins to grow faster than the economy itself. At that point, it becomes mathematically impossible to stabilize without major change. That's when a slow problem turns into a full-blown crisis. And that's exactly where we are now, deep into stage 2. And the reality is, America has been in this phase long enough that cracks are no longer forming quietly. They are becoming visible, verified. Which brings us to stage 3, the trigger. But here's the uncomfortable truth. The trigger isn't something in the future. It's already happening. And not just one, multiple triggers are hitting at the same time. Trigger 1: Oil and Geopolitics. At the end of February 2026, tensions in the Middle East escalated into direct military conflict involving Iran. Within days, Iran announced the closure of the Strait of Hormuz, one of the most critical energy choke points in the world. Nearly 20% of global oil and LNG flows through that single route. The reaction was immediate. Brent crude surged from around $80 to over $126 per barrel in less than 10 days. Now understand this clearly. Energy is the backbone of inflation. When oil prices jump, everything becomes expensive. Food, transport, manufacturing, supply chains, everything. And inflation is the number one enemy of the bond market because inflation erodes the real value of fixed returns. So, what do investors do? They demand higher yields, and to get those higher yields, they sell existing bonds. That selling pushes prices down, yields go up, and a dangerous cycle begins. Trigger 2: Cracks in Treasury auctions. Last week, something highly unusual happened. Treasury auctions for 2-year, 5-year, and 7-year bonds all showed weak demand at the same time. This almost never happens. The most concerning was the 2-year auction. Primary dealers, the buyers of last resort, ended up taking nearly 25% of the entire issue. Normally, they take around 11%. That's more than double. And even after that, the bonds had to be sold at a higher yield than expected. This is what traders call a tail, a sign that demand was so weak that the government had to sweeten the deal at the last second. At the same time, yields across short and medium term treasuries have jumped over 40 basis points since late February. The 10-year has moved to 4.44%. The 30-year is pushing dangerously close to 5%. These are not normal fluctuations. These are stress signals in the most important market in the world. Trigger 3: The Federal Reserve is stuck. At the end of March 2026, Fed Chair Jerome Powell indicated that the central bank is taking a wait and watch approach towards the oil shock. Sounds reasonable, but here's the problem. Inflation, measured by core PCE, was already at 3.1%, well above the 2% target even before oil prices surged. And now, the bond market is no longer expecting rate cuts. It's starting to price in rate hikes. That's the last thing this system can handle, because higher rates mean higher borrowing costs. And with $39 trillion in debt, even small increases explode interest expenses. Those costs are already near $1 trillion per year and rising fast. Meanwhile, the MOVE index, the bond market's fear gauge, is spiking. That signals instability, confusion, and policy pressure. In simple terms, the system is under stress right now. This is stage 3, confirmed. So what happens next? Stage 4. And if history repeats, and it usually does, this is where things get painful. If yields keep rising and growth slows down, you enter stagflation. High inflation, low growth. The worst combination any economy can face. We are already seeing early signs. Markets are reacting. The S&P 500 is down around 7% so far in 2026. Volatility is elevated. Mortgage rates are climbing again, heading towards 7%. For the average person, that means one thing: buying power is shrinking. Homes become less affordable. Businesses face higher borrowing costs. Growth slows down and the pressure builds. Now here's a level you need to watch very carefully. 5% on the 30-year Treasury yield. If it breaks and stays above that, it could trigger a massive repricing across all financial assets, similar to what we saw in 2008 or 2022. And here's the most critical part of all. The US government needs to refinance $10 trillion of debt this year alone at higher interest rates. Think about that. More debt, higher cost. At a time when demand is already weakening, the math becomes very difficult to sustain, and the bond market knows it. Now let's break three major myths that prevent people from seeing the reality. Myth 1. This time is different. This phrase has been repeated before every major crisis. Before 1994, before 2008, before 2022, and every time it proved wrong. The pattern never changes. Debt builds, inflation rises, a trigger hits, markets reprice. What changes is the scale, and this time the scale is bigger than ever. Myth 2. The Fed will fix everything. The Federal Reserve is in a difficult position. If it raises rates, it increases the government's interest burden. If it cuts rates, it risks fueling inflation. This is what economists call fiscal dominance. At some point, debt becomes so large that policy tools stop working normally. Even experts now acknowledge the bond market is in control, not the Fed, and the bond market follows math, not promises. Myth 3. America is untouchable. Yes, the dollar is the global reserve currency. Yes, treasuries are considered safe, but the data is shifting. Major foreign buyers like Japan and China are reducing their holdings. Foreign participation is declining. That means the US is becoming more dependent on domestic buyers, and domestic demand has limits. When those limits are tested, you get exactly what we saw: weak auctions and forced buying by primary dealers. That's not strength, that's a warning. So, what should you actually do? Because understanding without action creates fear, not results. First, know what you own. Long term bonds lose value quickly when yields rise. Even a 1% increase can significantly reduce prices. Second, short term instruments become more attractive. They offer decent returns with lower risk. Third, consider real assets, things that hold value when inflation rises, like commodities or inflation protected securities. Fourth, watch the bond market closely, especially the 30-year yield near 5%. Fifth, understand the housing impact. Higher rates mean slower growth and reduced affordability. Sixth, recognize that the Fed has limited options. There is no easy solution here. Seventh, monitor volatility indicators like the MOVE index. Bond market stress spreads to everything else. Eighth, stay liquid. In uncertain times, flexibility is power. Now step back and look at the big picture. The bond market is not just another market. It is the foundation of the financial system. And right now, it's sending a very clear message. Debt levels are too high. Interest costs are rising too fast. Inflation is not under control. And demand for government debt is weakening. This is not random. This is a pattern. The same pattern seen before every major bond crisis. And in every one of those cases, most people ignored the warning until it was too late. The bond market was right then, and it may be right now. So the question is, are you paying attention? If this video gave you insights you won't hear in mainstream discussions, then subscribe to Capital Explained right now, because this channel exists for moments exactly like this, when signals are clear but most people are still asleep. Watch the next video, because the next phase is already forming. The early movers will benefit, the late ones will regret it. Don't be late, subscribe. Share this with someone who needs to see it, and stay connected, because this story is just getting started.